Let's just start off with China, because activity in factories there slowed again in February. Are you concerned by this?
Well, I think you have to look at the potential for distortions in the data linked to the Chinese New Year, and I think one has to caution on that. But even allowing for that, it does look as if there has been some easing in activity, certainly if you look at the subcomponents. Our view at this stage is that the economy growth will soften in the first quarter to about 7%, and that again clearly linked to the credit tightening that's been taking place in the economy, in the financial system really, on the monetary side through the end of the year and in December. But we are assuming that the pickup in global growth will have an impact on manufactured exports, and that should be, I think, a positive as well. So we're not looking for a crunch, and we're not looking for a collapse in growth rates, but a gradual slowing, basically articulated clearly in the growth number for the Q1.
Okay, so that's China. How about your view on Europe? I know you are overweight Eurozone equities. A lot of the numbers that we've seen this morning are positive. If you're overweight, does this mean you expect positive earnings news from this region to continue?
Well, we're looking for a good year for earnings growth in Europe this year. We think it's the area that actually will deliver against expectations over the year. Part of it is obviously clearly the view that the recovery is getting underway. We're moving out of recession. The recovery is likely to gain some momentum during the year. But it's also, I think, balanced by the fact that a very accommodative stance by the ECB. We also view that the euro will decline markedly during the year. So that's a boon then for exporters, and those actually clearly dependent on the global sector, which is about half of the revenue base of the European listed market. So I think the attitude would be, we are seeing a recovery that should translate into profits, and financials should participate in that, particularly with the declining cost of funding in Europe. So we're looking at earnings growth in Europe for the full year at certainly above 10%, so one of the most solid of the international regions.
Okay, what's really interesting about your calls as well is you have a euro-dollar call of 124. We've got a lot of manufacturing data out of the Eurozone today. What do you expect from that?
Well, I mean, clearly the weakening of the euro is basically reflecting the shift in rate expectations between the various regions. So US anticipating a rate hike in 2015, as we do for the UK. Europe's still really pondering the issues of disinflation and continually very high unemployment. In terms of the PMI numbers, etc., I mean, clearly the view is we expect some softening, possibly manufacturing, services to pick up the slack, improvement there. The other issue is basically what happens with France, and generally speaking, the balance between the core and the periphery. Recently, you've seen a pickup in the core relative to the periphery. Will that be sustained? But generally, we are looking for now, again, a modest but sustained acceleration in growth through the first half of the year.